Over the past years, REIT share prices have steadily declined, even as they kept hiking their dividends, and as a result, they are today offering some of the highest dividend yields in many years. It's not uncommon to find even high-quality REITs offering dividend yields in excess of 8%. In the most extreme cases, you can find REITs now yielding as much as 12%. And I think that now could be your last chance to buy these REITs at such high yield levels. That's because the Fed is expected to cut interest rates in just a few weeks from now. I think that this will be a strong catalyst for the REIT sector, as it will lower the yields on money market funds and short-term treasuries and push a lot of that capital back into the REIT sector. But today you still have the chance to lock in these high yields, so don't miss out on this opportunity. Hey, this is Yossi. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to discuss 3 of my favorite high-yielding REITs offering up to 12% dividend yields. Now, as you go into this video, keep in mind that you obviously don't get such high yields without taking some risk. There's no such thing as a perfectly safe 12% yielding stock, but I like the risk reward of these companies, especially as part of a well-diversified portfolio. The first company I'm going to discuss is called Armada Hoffler, ticker symbol AHH. I've covered it quite a few times on this channel, but I'll try to give you a different angle to really bring my point home. The REIT is today priced at an exceptionally low valuation at just 6.5 times FFO, an estimated 45% discount to its net asset value, and an 8% dividend yield, despite a low payout ratio of just about 65%. And the reason why it's so heavily discounted is because the market hates this REIT. And unless you've done a lot of work on Armada Hoffler, it's pretty easy to understand why. On the surface, this is a small REIT with a diversified portfolio. The market doesn't like jacks of all trades. They prefer the REIT to specialize in something, and like Armada, it has quite a bit of leverage. It has a lot of development exposure, which increases risks. It also has some exposure to the office sector, which has suffered from the growing trend of remote work in recent years, and it has also recently cut its dividend, so it has a relatively poor track record. Put all of this together and you have a very undesirable REIT. But we don't see it this way. We think that Armada Hoffler is actually a relatively high quality REIT, and that's why we are buying this opportunity. Firstly, on its portfolio, the market sees Armada as a diversified REIT with exposure to the office sector. But that's not entirely accurate. Yes, the market is describing it as a diversified REIT, but in reality it's what we would describe as a mixed-use REIT, and there is no official property sector known as the mixed-use REIT sector, and this is the only REIT that specializes in this type of properties, which makes it difficult to categorize this REIT. But Armada is not typically investing in standalone office buildings and standalone apartment communities. Typically it's investing in mixed-use properties, and so this might be an entire complex with some office, some retail, some residential, often under one single roof, and these are very desirable properties. There's a lot of studies done on this topic that show that these mixed-use properties enjoy a lot of synergies between the different uses. Let's say you're the tenant of the office, you will of course enjoy the fact that perhaps your apartment in the same building in very close proximity, or that you have some restaurants, some cafes on the ground floor. There's synergies. The retail tenants are happy if above the retail there's a lot of apartments, so potential customers for their business. Likewise, the residential tenants like the fact that there are some cafes downstairs or a gym or whatever. And so these are very attractive properties that have historically enjoyed solid same property NOI growth, often above market rates of same property NOI growth, also above average occupancy rates. They're typically in walkable urban locations. So these are very attractive assets. Armada is a property developer. Typically they develop to sell, but they've decided to keep these specific properties for their own portfolio because they are so desirable. In this case, even the office component is doing really well, enjoying very high occupancy rates, long-term leases, steady rent growth. What about the management? Well, it's getting a lot of criticism today, and some of it is warranted. They came into the pandemic with too much leverage, too much development exposure as well, and as a result they've suffered in recent years, forcing them to even cut dividends twice. But it's interesting to know that up until the pandemic, the REIT actually had a very strong track record. It had massively outperformed the Vanguard Real Estate ETF, which is typically used as a benchmark for the average of the REIT sector. The management also has very significant skin in the game. They're one of the biggest shareholders, so they're well aligned with shareholders. They simply use too much leverage. Perhaps they have a higher risk tolerance. Leverage is not necessarily a bad thing. It really just depends on your objective, your tolerance for risk, and so on. But clearly, they've suffered over the past 5 years because of the pandemic, the historic surge in interest rates. These things were at least partially out of their control. We can blame them partially for it, but not entirely. But up until the pandemic, they had done a fantastic job, so I wouldn't describe them as a poor management team. Finally, the balance sheet. It's true that they have more leverage than the average REIT. Their debt to EBITDA is currently at 7 times, but here also it's important to know the context. They have a lot of development projects on the way, which is costing them money but not yet generating cash flow. As these development projects come online and are leased up, their debt to EBITDA is expected to drop much lower into the mid fives, and so the REIT is not quite as heavily leveraged as it may seem by simply looking at its current debt to EBITDA. So overall, we think that the portfolio, the management, the balance sheet are all higher quality than what the market is giving this REIT credit for. I'm not saying that this is the highest quality REIT in the entire market, but I don't think that it deserves to trade at 6.5 times FFO either. Its portfolio is enjoying steady rent growth, they have many development projects on the way that should be accretive to their FFO per share. Meanwhile, they're also deleveraging their balance sheet. The market simply doesn't like the fact that they've cut their dividend twice now over the past 5 years, but eventually I think they will move on and forget. I think that the dividend cut made a lot of sense given the situation they are in today with a lot of development projects, quite a lot of leverage, still high interest rates, and we're in an uncertain environment. To be safe, it made sense to retain more cash flow in their case, I think. And yet today they're offering a roughly 8% dividend yield with a now much more conservative payout ratio into the high 60s. I think fair value is at closer to 12 times FFO, which could unlock 50 to 70% upside from here, and that makes it very attractive in my opinion. So I think that the dividend should be sustainable at these levels, and especially so if interest rates now decline as we expect them to over the next year. According to the Fed Watch tool, interest rates are expected to drop 125 basis points within a year from now. That would put interest rates into the low threes, and that would make the dividend much safer than it already is. Long term, as the company deleverages its balance sheet, finishes its development projects, and interest rates returns to lower levels, we expect it to reprice at closer to 12 times FFO, which has the potential to result in about 80% upside from here. Naturally, you don't get this much upside, such a high yield, without taking risk. Again, this is a smaller REIT with some office exposure, a relatively poor track record on their dividend, and high leverage, but I think that the risk reward is quite attractive and the market is not giving it enough credit given the qualities that we just discussed. The second REIT on my list today is one that I've rarely discussed on this channel. I'm not sure if I've ever mentioned it. It's called Global Medical REIT, ticker symbol GMRE. This is yet another one that's not getting much love today, and it's easy to understand why. I mean, the entire REIT market is not getting any love. It's been a multi-year bear market, and the Global Medical REIT has dropped even more than the rest, given that it's a small cap with high leverage and it recently cut its dividend. But I think that the REIT is a lot better than what it gets credit for, just like in the case of Armada Hoffler. It owns mostly medical office buildings, which are today undersupplied and enjoying steady rent growth. Moreover, I think that its dividend cut only makes it more attractive, because until recently, the main reason why I wasn't buying this stock is because I thought that the dividend was unsustainable. I didn't want to own it through the dividend cut because I knew that a lot of its investors were income oriented. I expected them to sell off as it cuts dividend. That's exactly what happened, but now it's even cheaper. The payout ratio is now at a more reasonable level at about 70%, which will allow it to retain more cash flow to organically deleverage its balance sheet, and yet the dividend yield remains very attractive at right around 9%. The valuation is also very low at just about 8 times FFO. This is the lowest multiple for REIT focusing on medical office buildings. In fact, it's so low that the management recently announced a new share buyback program, which they expect to fund organically with this retained cash flow. The fact that they're able to do buybacks also indicates that the dividend should be sustainable. The leverage again here is relatively high with a debt to EBITDA of 7.5 times. So again, you're not getting a 9% dividend yield without taking some risks, but ultimately because rents are growing in this property sector they're now retaining enough cash flow to deleverage organically, I think that the dividend should be sustainable going forward, especially if interest rates are cut as significantly as we expect over the next year. Fair value, in our opinion, is again at about 12 times FFO, which has the potential to result in nearly 50% upside from here. And while we wait, we're earning this very high dividend yield. Hey, before I go into the third REIT, can you please do me a huge favor and click the like button and subscribe to the channel? It helps me a lot to keep on growing. Thanks so much in advance. The third REIT is one that I just recently covered on this channel. It's called New Lake Capital Partners, ticker symbol NLCP. Instead of repeating everything that I said in my previous video, I'll put a link to it in the description of this video. So if you're unfamiliar with the company, you can start there. Today I just want to share an update concerning its recent earnings call. But just shortly, New Lake is a REIT that specializes in cannabis cultivation facilities, which is a riskier property sector, and as a result, it's today priced at a 12% dividend yield. Typically, when a REIT is priced at such a high yield, it's a very clear red flag. It typically indicates that the dividend is not sustainable, because the REIT is probably over-leveraged, poorly managed, or owns really risky properties with declining cash flows. But in the case of NewLake, all of this is not really true. First of all, the management is very shareholder-friendly. They have an amazing track record. They've grown their dividend in every year since going public. They own a lot of equity themselves. I've gotten to interview the CEO quite a few times for High Yield Landlord, and I hold them in very high regard. On the balance sheet, unique to this REIT is they have no debt. I mean, they have very little, but they have even more cash, so they're net cash positive, which puts them in a very strong position to deal with whatever potential headwinds they could be coming from their portfolio. And then thirdly, while it's true that the cannabis sector is riskier with frequent lease defaults and non-payments of rent and so on, so it's a natural part of this business, I think that the risks are not quite as high as what the market appears to think, because they have many risk mitigating factors that makes the portfolio safer than what it might appear to be. Firstly, its properties are all under triple net leases with very long lease terms of about 14 years that result in very steady cash flow with annual rent escalations. Tenants also responsible for all property expenses. So as long as they're able to pay for their rent, the cash flow should be very steady and predictable. Beyond that, it focuses on limited license jurisdictions where the supply of these properties is limited by the licenses, but the demand for cannabis keeps growing steadily. Therefore, even if they face occasional lease defaults, there should still be demand for these properties given the growing demand for cannabis. Finally, its properties enjoy high rent coverage ratios. I'll put a chart on the screen and you'll see there that there's plenty of margin of safety. The REIT has hiked its dividend every year since going public, sometimes a few times, and when asked about the dividend on the recent earnings call, the CEO said the following. Our second quarter dividend of 43 cents per share represented an AFFO payout ratio of 79%, just below our targeted range of 80 to 90%. Our portfolio has remained resilient through a difficult period for the cannabis sector, though we recognize that we are not immune to the ongoing financial pressure faced by some of our industry participants. So yes, their property sector is riskier than most others, but they have focused on safer properties in this risky segment, and they have plenty of margin of safety given the fact that they have no leverage and they have a low payout ratio that's even lower than their targeted range. Therefore, I think it's unlikely to be cut anytime. I think that there's enough margin of safety there. In my opinion, this is arguably the safest 12% yield that you can find in the REIT market today. That doesn't mean that it's safe. It's still a relatively risky company. I mean, this is a small REIT that focuses on the cannabis sector. However, again, I think that the risk reward is very attractive given its low valuation and high yield. For this reason, we own it in our core portfolio at High Yield Landlord, which aims to maximize total returns, all while earning a high yield. And this, of course, comes at the expense of higher volatility. In contrast, our retirement portfolio aims to maximize safe income, but this strategy is a lot safer, so it will typically focus on blue chip REITs with investment grade ratings. You need to decide what you're looking for. Both approaches can make a lot of sense depending on your objectives and risk tolerance. If you want to access our full portfolios, you can join us for a 2-week free trial. It will be the first link in the description of this video. This will also give you immediate access to all our transactions in real time, all our best research, and our exclusive CEO interviews, including a recent one with the CEO of NewLake Capital Partners. Once more, if you could please click the like button and subscribe to our channel, it will help me a lot. Thanks so much in advance. See you at my next one. Bye-bye.